We're going to look at Unit 2, which is conceptual framework. And the outline of my class will be as follows. We'll look at some of the regulatory systems that have been put in place for financial accounting. By now, you should know that accounting is guided by rules and standards. So we'll look at the available accounting standards. Later on, we'll look at the conceptual framework for reporting, the objectives, the elements imbued in it, the qualitative characteristics of financial accounting information, the assumptions, the principles of accounting, and the constraints. So once we've done that, we will then look at a few questions. To start with, we are going to do a quick recap of what we had in the previous class. Do we remember what we discussed in the previous class? What is the definition of financial accounting? Financial accounting from the previous class was defined as what? As a branch of accounting which involves the process of recording, the process of summarizing, the process of reporting, a series of transactions that result from business transaction over a period of time. So accounting should be in accordance with established concepts and principles, standards, and also legal requirements by means of three important books we're going to look at. Number one, books that are called income statements. These are part of the final account. Number two, the balance sheet. And number three, the cash flow statement. These are the key books that we are going to look at. So at the end of each period. So the conceptual framework system has the following surrounding it. We have international financial reporting standard that the financial reporting system must abide. We have the stock exchange rules and the national company legislation in Zambia, 388. So there's a regulatory framework, which is legislative. You have international financial accounting reporting standard and also the stock exchange rules. Now, what are these accounting standards? Accounting standards denoted by IAS and the authoritative pronouncements that explain how to deal with certain accounting problems. For instance, how do we deal with stock when we're evaluating it? How do we deal with property and equipment in terms of cost? So there are standards that have been put in place which are called International Accounting Standard, IAS. They are the guiding principles of financial accounting because it's called Principles of Financial Accounting. So these rules are important in this. Why do we need accounting standards? The reason is that we need to have a uniform or consistent form in which these accounts are presented. And so it is a requirement whenever you're presenting your statements, you need to follow a standard pattern, standard form that you need to use throughout a particular company. If you start with a particular accounting standard, it is a requirement that you need to be consistent about by it. So depending on the type of entity, we have the private sector and the public sector. We have accounting standards that govern them. So for the private sector, we have the IFRS, which are the International Financial Reporting Standards that they need to use. Whereas the public sector, like the government entities, they have what we call the International Public Sector Accounting Standard, IPSAS. So these ones will govern the private sector, the international financial reporting standards, whereas the public sector, the international public sector accounting standard. When we look at the private sector, which is governed by the international financial reporting standard, here is the list of them. So these ones are listed from 1 to 20, down to 7, and to 41. Depending on the sector that you are in, the standards that you need to follow. IS, in short, governs the inventory. IS2, inventory. IS7, the cash flow statement. IS8 looks at the accounting policies, changes in accounting, estimates and errors. There's IS10, which looks at events and after reporting periods. How do you report such? Construction sector also has its reporting financial statement standard, which is IS11. Income tax is IS12. There are also other regulatory frameworks that govern taxes, which is 12. Plant and equipment, 16. 17, leases. 18, revenue. 19, employee benefit. 20, we're looking at accounting for government grants and disclosure of government assistance. So these ones are many. All you need to know, at least to have an idea, that there's always a standard that will govern each of these. So we have the borrowing costs in the private sector, related property disclosure, 24, accounting and reporting by retire benefit plans, 26, 27, consolidated and separate financial statements, 28, investment in associates, 29, financial reporting in hyperinflationary economies, 31, interest in joint ventures, 32, we're looking at financial instrument representation, 33, we're looking at earnings per share, interim financial reporting, impairment of assets and provisions, contingent liabilities and contingent assets. This is from 31, 32, 33 up to 37. And finally, we also have some to do with the intangible assets. So we have 39, 40, and 41 to do with financial instruments. Okay, so we also have intangible assets. 39 looks at the financial instrument. 40 looks at investment property, and 41 looks at agriculture. So we also have IFRS 1 to 8. So these ones just needs to know the list of these standards that govern each of these components. Insurance contracts, exploration of mineral resources, FRS 6, lots of instruments of disclosure, operating segments. I will not explain each of these ones in depth, but just to have an idea that we have all these reporting standards. Now, what is the conceptual framework for in terms of financial reporting? What is it? So it is actually a comprehensive set of concepts for financial reporting, which is issued by the International Accounting Standards Board. So the conceptual framework for financial reporting also provides concepts and guidance that will underpin the decision that the board may make when developing standards. So even if they're to make independent decisions, they should be within the framework. So our revised conceptual framework, which was issued in 2018, was recently revised January 2020. So this date you need to take note of. The revision was in 2020. That was a recent date. So the purpose of the financial framework is, number one, to assist the board to develop the reporting standards based on consistent concepts, which may result in financial information that could be useful to investors, the lenders, and other creditors. It is also important because it helps assist in people who prepare financial reports to develop a consistent accounting policy for the transaction or for other events. When there's no standard that applies to them, they can use a choice of their own within the frameworks that have been outlined. So whenever they're coming with those accounting standards, they looked at the various constituents that are available in terms of reporting. How do we report accounts to do with partnership, charitable organization, government institutions? So they came up with accounting formats or standards, as we may call. So the conceptual framework is also there to assist all parties to understand and interpret these standards. So this is just an illustration of the framework, which has the following components. They are what are called assumptions, they are what are called principles, they are what are called constraints. So under the elements, we have assets, liabilities, equity, income, and expenses. Under the qualitative elements or characteristics, we have the following. Now, this was important to take note because these are questions that the quiz would want to pin you on. So we have elements, which include assets, liabilities, equity, income, and expenses. Assets are simply what the business owns. Liabilities are simply what the business owes. Equity is simply what the owner of the business have put into the business from their own pocket in terms of money or in terms of the borrowed machinery. Then income and expenses. Expenses are simply out-of-pocket expenditures, and income are receipts that a company or a business may receive in terms of sales or selling an asset and receive income. We also have qualitative characteristics. Is one called the fundamental qualities include relevance. Relevance has predictive value, confirmatory value, materiality. Here we have faithful representation. It includes completeness, neutrality, and free from error. Now, these characteristics of financial information as follows. When we are dealing with relevance, it should have a predictive value. This means that whenever we're dealing with estimations of amounts, we are settling for certain values for which we're not sure of. At least the value must be predictive, must be known. Then confirmatory value, where we can confirm the value of a particular item that we wish to disclose. Materiality falls from materiality concept. So there are certain small components of a business transaction that could be coined into something that could be collectively regarded. For instance, you cannot have a pen account, a ball pen account, you cannot have a rubber band account. All these collectively could be called stationary, looking at the materiality value of the particular asset you're dealing with. In faith representation, looks at how complete and how representative your reports are. They need to be complete. Anything that is incomplete is no information at all, according to accountants. They need to be neutral, neutrality, meaning they should give fair balance of information. They need to be free from bias or free from error. They need to be spotless. Then the other group of characteristics, the qualitative characteristics, is the enhancing qualities. So we have comparability, verifiability, timeliness, and understandability. Comparability is simply quality where when you produce accounting information, it must be comparable. You must be able to compare it from one year to the other using the accounting standards that we're using. So it helps you to have that aspect of comparability. Okay, so when you're dealing with comparability, reports that you're producing must be able to be compared over time because of the accounting standards that are there. This is what we actually use in the assignment, where we're going to use ratio analysis, the horizontal analysis. You're able to compare one statement to the other. Verifiability, the report must be verifiable using any audit to ensure that the values that you put in correspond to other related transactions to that account. Timeliness is an important quality of information. Information must be produced at a particular time, otherwise it will be irrelevant. So like a newspaper, certain financial transactions, if they are out of time, may not be relevant at that particular time when you do the report. And understandability is also one key aspect of good quantitative characteristics, because all accounting information must be understandable to the end user. These are the elements of qualitative information. When we go to objectives, objective of conceptual framework must be to provide information about the reporting entity that is useful. It must also present potential equity investors and lenders and other creditors in their capacity as capital providers. So the objective is to provide information, number one, which will be essential for reporting equity. Now, this equity is very useful to present to potential investors, to present to potential equity lenders and other creditors that may be available. So once the financial information is presented in accordance to, or in accordance with this conceptual framework, it may avail company able lenders, because usually companies, especially in the private sector, will be keen to having as many financiers as possible. So objectives of financial statement, number one, is to provide information that will be useful to who? To the users. In what decision relating to providing resources to the entity. So this is one of the key objectives, is to provide information to who? Users. For what? For decisions relating to providing resources to the entity. Matters dealt with in the IASB's framework. This framework is concerned about the following. Number one, complete set of financial statements must include financial position. Number two, it must include the comprehensive income statement. Number three, it must include the cash flow statement, which are the statements of equity and also other statements. So these are the key statements that are included in the financial statement. Financial position, which is the balance sheet, the comprehensive statement, which is the income, trading and profit and loss account, and the cash flow statement. Others are statements of equity. These are what make up what we call the financial statements. The elements of financial statements are as follows. We have assets, we have liabilities, we have equity. And the equation that we use whenever we are dealing with accounting equation is equal to assets is equal to what? Who remembers? How are these three related using the accounting equation?
Is equal to equity plus liability.
Yes. Equity plus liability. So these are the elements of financial statement. They should include assets. Now we explained assets in depth as being what the company owns. So assets are classified into three main categories. We have what we call current assets, non-current assets. Current assets and non-current assets, also intangible assets. What are the current assets? What are the non-current assets? what are the intangible assets quickly. What are the current assets? Dealing with assets. Current assets are simply assets that are easily convertible into cash. These include cash itself, cash at bank, we have inventory, we have debtors, we have prepayments. So these are the assets that a company may be looking at. Debtors are also called account receivable. Inventory is also called stock. The non-current assets are actually fixed assets. So after having a meeting, it was adopted that fixed assets are now called non-current assets. These include land, machinery, equipment, fittings and fixtures. So these assets here compose a component that we call capital expenditure. Expenditure that a business will usually have on capital asset is called capital expenditure. And these ones are usually meant for use in a business. Then we have intangible assets that include goodwill, franchise, good name that a business would enjoy because of trade relations. So those are called intangible assets. And we have equity. Equity includes share capital, accumulated reserves, and other reserves. Okay, so equity is simply what owners of the business will place through shares. So we call that share capital. And this one usually emanates from preferential shareholders. Other added parts to equity, sometimes revenue. So this is part of the elements that are found in financial statements. So revenues include our sale of assets. Expenses include expenditures like rent, wages. These ones are different from capital expenditure because revenue expenditure is usually spent on maintaining our assets that are available. And repairs, depreciation, payment of salaries, bank loans, charges, etc. We also have gains and losses, which may come in terms of net profit, net losses, gross profit, and gross losses. So these are the 6 key elements of financial statement. So definition of an asset, simply an economic resource controlled the entity as a result of past events. It's an economic resource. Economic resource is a right that has potential to produce economic benefits. This cash, does, and motor vehicles. So these assets I've already explained may be categorized as current and non-current, as well as intangible. Look at liabilities. This is simply an obligation to pay. Liabilities are what we owe as a business, an entity, to a transfer of economic resources as a result of past events. It's a duty or responsibility that the entity has to pay. We have examples of liabilities could be current liabilities and non-current liabilities. Current and non-current liabilities. So current liabilities are simply owings that are payable within a year or less. Current liabilities will include loan payments are due within a year, bank loan, and amounts payable. Can you hear me? Are we together?
Yes.
So current liabilities are simply amounts that are payable, which are due within a period of a year and less. So we have the bank loan, we have accruals. Accruals are simply payments that were supposed to be paid but are not paid. For instance, wages that we're supposed to pay are called accrued wages. Salaries that we're supposed to pay are called accrued salaries. Interest payable is also an accrual or an accrued payment. So all these amounts that we need to pay are called current liabilities. We also have sundry creditors. A creditor is a person that we owe. So if the amount is payable within a year, we call it what? A current liability. Non-current liabilities are simply long-term liabilities. These are amounts that are due for a period of 1 year and above. These ones include bonds or even bank loans that are due more than a year. And also we have what we call debentures. So all these ones are called what? They're called our non-current liabilities. Expenses will either decrease an asset or increase the liability. So when expenses are incurred, they will also decrease equity and other related to distribution to the holders of equity. So examples of expenses are telephone expenses, salaries, depreciation, and revaluation of assets. Now, I explained expenses to being in two. We have what we call revenue expenditure. This is an expense which only appears in what is called the profit and loss account. It comes as operating expenses. Then we also have expenses which appear in the balance sheet. They're called what? Capital expenditure. This is what we call fixed assets or the non-current assets. So they are a special kind of expenditure, except that we don't charge it under the profit and loss because they will understate your profit. So when we're dealing with revenue and income, we're looking at the increases in assets or decreases in liabilities that may result in an activity relating to a business. It may come through a cash sale or a credit sale, or receipts of what rentals if you are owning businesses that are in estate. Equity or capital simply looks at the amounts that are put in business by the owners, maybe share capital or retained earnings. Retained earnings that we're looking at here are simply plowed back profits from the previous accounting year. So qualitative characteristics of financial elements, as we explained, are divided into two main groups. They're what we call fundamental quantitative characteristics and enhancing qualitative characteristics. So the fundamental ones are to do with relevance and faithful representation. I explained them in depth. The other ones are to do with what? Comparability, timeliness, understandability, and verifiability. So you need to distinguish which ones of these ones are actually characteristics and which ones are principles. So for fundamental qualitative characteristics, they are useful in the sense that they must both be relevant and must provide a faithful representation of what purports to be representative. Relevance and faithful representation are very fundamental characteristics of financial statements that give it useful for the end users. When we are looking at relevance, it means information must be relevant, must be capable of making a difference for decision making by the users. This information should be capable of making a difference in decision making. When we're dealing with faithful representation, we're actually looking at the substance of what it's supposed to represent. Faithful representation, to its maximum extent, must be complete. It It must be neutral. It must be free from what? Error and bias. Neutral means it must not be in favor of the company, maybe to avoid taxes. And it must be objective. Complete, it must not leave out any relevant information that may be deemed useful. As a faithful representation, it is affected by the measurement of uncertainty. And when you're looking at enhancing qualitative characteristics, there are 4 elements: understandability, timeliness, and verifiability. These ones enhance the usefulness of the information, but they cannot make non-useful information useful. These characteristics, no matter how vital they are, they cannot make non-useful information useful. That's why these ones are known as the fundamental one aspects of what? Relevance and faithful representation. These are fundamental. They are the background. They are actually useful financial information, but these ones are just accompaniment. They enhance the usefulness of the financial information. They can never at any point make non-useful information useful, no matter how understandable they are, how timely they are, how verifiable they can be. If they do not meet the faithful representation attribute, either would they be relevant, then they are not as useful. In short, they could be useless. Understandability, this attribute, we mean that information must be presented in such a way that even a layman can understand them, you and me, the basic users. For this to happen, it is assumed that users are assumed to have just some basic business or economic knowledge about accounting, and they just need enough to know how it may be appropriate to them, so it must be understandable. If it's complex, it will not benefit the end user. It will be like econometrics with them. Verifiability is simply a concept that will help them assure the end users that this one represents a faithful account of a phenomenon, that to some extent they can reproduce evidence to verify their assumptions. So comparability, this means that the users can use this to compare with other financial statements through a trend of analysis from one accounting period to another to see whether this is making accounting sense. Just recently, we had the previous Commissioner General for ZRA, who really failed to understand the performance of ZRA because of this concept of comparability. He said there are certain things that have been hidden because when you're making a report, there are certain constituents, there are standards that must be put in place. According to his allegations, that he made the picture look as if ZRA was performing well when it wasn't, because of this component of comparability. It must be compared with other statements that have been produced before to evaluate the relative financial position. So relative means based on the previous performances. Timeliness is a key issue because usefulness of financial statements must be subject to time. So if it's out of date, it is useless. Just like I said, like a newspaper, it is only relevant if produced within a particular given time. Now, we must understand that there are also what we call underlying assumptions. And these ones are as follows. There's what we call underlying assumptions. These are defined as the basic assumptions that underlie the preparation of financial accounts. So we have the reporting entity, the going concern, the monetary unit, and the periodicity. So I think I mentioned this in the previous session. Anyone who can remember any of these ones? What does reporting entity, going concern, monetary unit, and periodicity imply? Anyone? Aaron?
I missed that, Colin, sorry.
Do you remember any of these entities that you can explain as the assumption, what is meant by reporting entity or consent or monetary unit or periodicity?
The reporting entity refers to the report that it should do include the organization that it is, in my understanding. Then the going concern talks about the entity showing that it still has a future. It still exists even into the future.
No.
Then the monetary unit talks about the unit measure that it should do indicate in which, whether it's in kwacha, dollar, that the entity is referring
Currency.
to in its report. Yeah, then the periodicity, maybe that one I may not understand.
Oh, that's very
Thank
good.
you.
Who wants to help on the periodicity? Okay, great. So going concern really, as she put it, is an assumption that reflects a business should have a going concern, the foreseeable future. It is yet to operate instead of being closed or sold. In case any person died, it still has what? A future. Right now, you look at it as this. In future, you're looking at what? Fleet of planes. Right now, you're seeing a tuition center. Tomorrow, you're seeing what? A university. The monetary unit assumption is simply the assumption that we should express transaction in currency or monetary form. And the reporting entity is simply the assumption that an entity is required or chooses to prepare financial statements that is not necessarily a legal entity. It could be a portion of an entity or may comprise of more than one entity. So it is concerned about separately dealing with issues of the person should be deemed as different from that of the owner. So the entity concept, entity assumption simply separates the business affairs from the individual themselves. The time period assumption simply presumes that the life of a company is divided into periods such as months, years. So the time period looks at this assumption that the life of a company can be divided into time as prescribed. So the accounting principles also include the following: it's cost, revenue recognition, matching, and full disclosure. These are a component or constituent of accounting principles. So principles of accounting are as follows. There's what is called the revenue recognition principle, which simply recognizes revenue when it's earned, not when you actually received cash. So for instance, if you're dealing with a transaction where you sold goods on credit, you record it as an entity, not when you receive money. The proceeds need not to be in cash. So you could still recognize that as a revenue, even if it was not made by cash. The other one is the cost principle, which is accounting information must be based on the actual cost and not on the current market value. The actual cost is considered to be objective. For instance, if you buy land at 50,000 and next year it is worth 100, so the cost principle must be based on how much you bought it then. The matching principle is on the assumption that a company must record its expenses incurred to generate revenue in the period in which they were recorded. For instance, if you have salaries that are supposed to be paid this year, but you've enjoyed the concept of the service, you should not relent recording it because you have enjoyed the service. So you need to have that recorded in the expenses in the period in which they were incurred, not in the following year because they paid in the following year. Full disclosure principle simply assess that a company is required to report details behind the financial statement that would impact users' decision making. So there are short notes that will need to be included that the person may understand a block figure that has no sub-constituencies that need to be broken down, it is important that you do so. And the constraints include the cost benefit, industry practice, conservatives. So cost benefit talks about the benefit of providing information needs to justify the cost of providing and using the information. So, for instance, cost and benefit of full compliance with accounting standards should be considered. For example, for dealing with SMEs, exemptions are given from compliance with certain standards. So the constraint that we have with the conceptual frameworks are as follows. The first one is that we have a cost benefit constraint, which says that the benefit of providing information needs have to justify the cost of providing and using the information. So this is to say that for certain institutions, full disclosure compliance with accountants must be considered. For instance, SMEs are exempted from compliance with certain standards because it may not be relevant for them. There's other constraint, which is the industry practice, which is another constraint that in preparing financial statements, industry practice must be taken into account because the accounting standards are generalized, but industries may really object to certain standards because they may not relate to them. And other constraints are conservatism or prudence constraints, which are said that the accountant should adopt procedures which do not overstate or anticipate revenues, and also which do not understate the expenses. So it's a prudence concept which says that the accountant should adopt procedures that will not overstate their revenues, or also anticipate their revenues. Also, it shouldn't adopt procedures that will understate the expenses, because this is a way in which people want to dodge paying taxes. So profits should be included only when it is reasonably certain that cash should be received. That's why we also have provisions for doubtful debt. This is part of the prudence concept, where you recognize that some of the debts may not be paid. There's also recognition and derecognition of elements. This is a process of capturing for inclusion the statements of financial position or performance, an asset that meets the definition of an asset, liability, equity, income, or expenses. The recognition concept is really appropriate because it results in both relevance and faithful representation. So recognition is actually the removal of all or part of a recognized asset from the entity because of what I said above. So the recognition will normally occur, for instance, when you're dealing with an asset, when that entity loses control of all or part of the recognized asset, then we would recognize it. When a liability no longer has a present obligation for all or part of the recognized liability, so we would recognize it. Sometimes when a company will want to undergo a liquidation. So this is what this one was all about. So a quick follow-up. Which one of the following is an example of an element within equity? Which one of the following is an example of an element within equity? Okay. So we looked at this. So there was evaluation, reserves, bank, and cash, stock, liabilities. So an element that is within equity, I talked about it, reserve. These ones sometimes are called what? Retained earnings. These are part of equity. Okay. Then which one of the following is not part of the regulatory accounting framework? Which one is not part of the regulatory framework of accounting? So national company legislation, act for governance, international financial standards, the stock exchange rules listed for companies. So which one is not? Regulatory framework. You remember that diagram that we had here. So which one is not part of this? Exchange, yes. National fund legislation, international reporting. So which one is not? From here. So this one is not. So this quiz was one which was wrong. It was this one. So this is part. So this one is not part. This one is, and this one is. Correct. Okay. The question has been omitted there. We'll go to this one. Revise conceptual framework. The financial reporting became effective when? 2020. That's true? Yes. What was the initial date? 2018. Remember? Okay. Then answer following with the correct classifications in the conceptual framework. So revenue recognition is a principal, assumption, or element. Revenue recognition is a principle. Going concern is an assumption, and share capital is an element. Okay. So which one of the following is an enhancing qualitative characteristic? So we have two main categories. There's enhancing and what? Enhancing and fundamental. Enhancing and what? Fundamental qualitative characteristics. So quickly, we had a list of enhancing and qualitative characteristics. So under the fundamental, we only had two: relevance, what? To representation. So under enhancing, we have comparability, timeliness, and understandability, and verifiability. The question is, which one of the following is an enhancing characteristic? So when you go here, in enhancing, we have any of these four. Which one qualifies? Understandability is one. So you think that, right? So it's interesting when you understand it as follows. Which of the following is not true about international financial reporting standards? So they provide a common form of content. This one is true. Issued International Accounting Standards Board. This one is true. Issued by the International Public Sector Accounting Standards Board. This is not true. Okay. This actually relates to public entities. Yeah. Authoritative pronouncement that explain how to deal with accounting problems. This one is true. When we go to the next one, objective of financial statements to provide information useful to who? The constituencies. Very boldly is useful to users. So this is how you click down here, it will give you constituencies, then you choose users. The objective of financial statements is to provide information that is useful to user systems. Repetition. Which one of the following is not a current value measurement base? Which one of the following is not current value measurement base? Value news, historical cost, fair value, current cost. So it was historical cost. Which one of the following is not a requirement according to the Companies Act in Zambia? Which one is not a requirement? Content of annual report. This one is. Obligation to prepare annual account. This one is. Small private company need not appoint an auditor. This one is not a requirement for private companies, but for public statement of comprehensive income must be signed by the director. This is not requisite in the Companies Act, so this is our answer. So finally, but not the least, financial reporting is concerned with the purpose of what? Using financial statements. A complete set of financial statements does not include, so we looked at what it includes. So I highlighted what is included in the financial statement. We had listed them. We have balance sheet, which is the income statement, and the balance sheet, which is the financial position. We have the comprehensive statement. We have the cash flow statement. There's no cash flow here. When you check here, there's a financial position, which is a balance sheet. Yes. Comprehensive income statement, which is a profit and loss. Yes. Also have the what? Statement of cash flows. There's no cash flow. Which one is not? So cash flow is not.